Is the Fed about to bail out the banks again? The buzz around the financial community right now is all about the 400 plus billion in overnight loans between the Fed and the large commercial banks that is causing some potential unknown stress to the financial system that either could blow up spectacularly or be nothing. Now, with the FOMC press conference coming in less than 2 weeks as the next meeting starts, there's a lot of questions circling. Will the Fed address this, and what will they do? And we're going to talk about what the problem is, what the real solution should be, and how the Fed can pull off a bank bailout without getting in any trouble. All that and more on today's Macro Show. I'm your host, Steven Van Metre, and thanks for joining me today. Let's just get right into our headline story. And this is this overnight loans to the Fed. It's called reverse repo. And what's going on here is the banks have so much cash from all these stimulus checks that they're having to swap it with the Fed for a 0% overnight loan to get some pristine collateral. Now, if you're wondering what pristine collateral is, those are T-bills and short-term T-notes. They need Treasury securities, and there just isn't enough of them, which is odd because right now, nobody seems to want them, but the banks need them in big numbers. How big, you're asking? What, 10, 20 billion? No. Here is today's reverse repo operation, and the bank submitted $438.8 billion in cash for an overnight loan to get Treasury securities from the Fed. That is staggering. Now, what is the proper fix to this problem? Because this is an issue. Now, if you're wondering, is this what we saw before the great financial crisis? Actually, we saw the exact opposite. We saw a shortage of cash in the banking system. Now we have too much, which of course is being perceived as, well, that can't be too bad. It can't lead to a problem. Well, maybe it can, but the Fed has got a solution to this that they can pull off without anybody stopping them. Let's talk about what the proper solution is here. So the banks are short the collateral they want. Now, how would you get that if the collateral you want is Treasury securities? Well, former Fed chair, now Treasury Secretary Janet Yellen, head of the Treasury, should go to the banks and find out exactly what they want issued and then adjust all the issuance of the monthly Treasury security auctions to match what the banks want to deal with this problem. And she and the Treasury have already said, not our problem. We're going to leave that up to the Fed. Now, the Fed's got a problem because all they can do is this reverse repo. All they can do is accept cash from the banks and give them an overnight loan. But do they have enough Treasury securities to keep doing this? Well, let's take a look at the Fed's balance sheet. And this is released weekly. This is the H.4.1. And here you can see U.S. Treasury securities. The Fed has 5 trillion of them. So you say, well, that seems to be a lot more than a 400 billion. But we know the banks really want T-bills. They want a lot of T-bills. This is the most pristine collateral. And look at bills right here. The Fed only has 326 billion. The rest they're holding in notes and bonds, meaning if the Fed wanted to, if the Fed said, hey, we're going to come in here and swap these bills with the banks for other collateral, they don't even have enough of it. And so the banks are so desperate, they're probably borrowing all of the bills the Fed has plus some notes, and yet the Treasury is sitting there saying, not our problem. So how can the Fed fix this? They can do something called an Operation Twist. And not only can they do this, no regulatory oversight to this. Nobody, Congress, the president, nobody can stop them from getting collateral into the banking system. Now, how would they do that? Well, it's pretty simple. The Fed has something that clearly the banks want. How do we know? Well, because we can see this daily repo operations, which has been well over 400 billion, that says the Fed has something the banks want. So all the Fed would have to do is say, to maintain what's called a balance sheet neutral transaction, meaning we're going to take something off our balance sheet, give it to you, and you're going to give us something back of equivalent value. So our balance sheet doesn't change. So we are neither tightening nor easing. How would they do that? It's called an Operation Twist. And what that would entail is the Fed telling the commercial banks, we will swap you whatever it is you want, T-bills, short-term T-notes, whatever it is you want, for something that you don't want but can go get. So what we're seeing right now in the system is there isn't enough T-bills and notes, short-term notes, to meet the demand from the banks. So what the banks would then do is go out and buy intermediate, long-term notes, even bonds, and then go to the Fed and say, hey, I'll swap you these things I have but don't want for things I do want. So from a Fed's perspective, the balance sheet transaction would be neutral. It would give the banks what they want, the pristine collateral, and keep the Fed's operation the same. So if anyone called the Fed out, they would say, we didn't do anything. We were just meeting the demand of the market. It was a balance sheet neutral transaction. We neither eased, we neither tightened. We didn't do anything but alleviate the problem in the banking industry. Now, this is interesting because we have an FOMC, or Federal Open Market Committee, meeting starting in less than 2 weeks. And that is where the Fed makes their policy decisions. And it's going to be hard for them not to address this issue because it's a huge one. And everyone's asking right now, what the heck is going on? Is this going to cause an odd meltdown? Because last time we had a problem, there was a dollar shortage. There was too little cash in the banking system. Now we know there's a dollar shortage, but there's too much cash in the banking system. Can that cause a problem? This is where the Fed will need to step up and act. Can they pull this off? Absolutely. Will they? We don't know. But if this is let to run even longer, could it lead to some form of problem? Oh, absolutely it can, because the banks are choking on all of this money. You see, the bigger the bank balance sheets get under these Basel III banking regulations, those are the post-Great Financial Crisis banking regulations, the more penalties the banks get. So the banks are not incentivized to expand their balance sheet. And yet, through fiscal stimulus, we're just ramming it down their throat. But it gets even worse. Most of the money is going to Bank of America and JP Morgan Chase. Wells Fargo sitting in the penalty box because former Fed chair Janet Yellen limited their balance sheet growth when she was in charge of the Fed. And Citibank, the other big bank, well, they're not a big player in the retail space, so they haven't been a recipient of many of these stimulus checks, putting all of the burden on Bank of America and JP Morgan, which then makes this even more interesting because those of you who read the research of Zoltan Pozsar, the economist from Credit Suisse, you know that he's talked about if the Fed can unleash Wells Fargo, it could spur somewhere between an immediate $100 billion of Treasury security buying up to $500 billion to take the pressure off JP Morgan and Wells Fargo. So could we see at the next Fed meeting, finally the Fed deal with Wells Fargo, and perhaps at the same time do an Operation Twist, bail out the banks again? Now, you know that's not going to be popular with taxpayers, but there's nothing anyone can do to stop them. Now let's take a look at the economic data because there's a lot of this manufacturing PMI data. If you're not familiar with the term PMI, it's a Purchasing Managers Index. And this is a survey of the manufacturing sector. And this is real important from a macro perspective because when the survey data is rising and rising quickly, well, it means the manufacturing sector is expanding, as is the economy. And if you look at it from a global perspective, you can see around the world what's going on. Now, when these peak or are near a peak, it also seems to signal that a peak in equity prices is near. And when they start to slow down their growth, it tells you that an inevitable turn in the equity markets is coming. And it also, in a matching way, signals a peak in treasury yields and lower interest rates. So when you see these PMIs start to peak out, you look for treasury yields to peak as well. And as they pull back down, guess what? You're going to see yields head down. So these are real important. Let's take a look at the economic data and see what's going on with those and the other things that we find every week to take a look at. Let's start here with Japan, manufacturing PMI. Now, the way you read this is 50 is unchanged, over 50 is expansion, under 50 is contraction, and the higher the number above 50, the faster the expansion, the lower the number below 50, the faster the contraction. So what we see in Japan is last month at 52.5, there was a slight expansion. This month at 53 for May, slight expansion. So things are slowly improving in Japan, but not real quickly. And we know from prior reports that the manufacturing sector in Japan is really struggling. So how about we look at China now coming out of the Monday night data. And if you're the biggest exporter in the world, which China is, then you want to see this really growing in the manufacturing sector as a leading indicator of what's going on in the rest of the world. And what do we see? A print at 52, which means that the Chinese manufacturing sector isn't expanding very quickly. You can say slight, perhaps even very slight expansion at 52, suggesting that all of this demand that we're hearing about, at least out of the United States, perhaps isn't as true, because if there was all this demand, we should be seeing the Chinese manufacturing sector booming to try to meet that demand. The other factor here is when you think about inflation and this data, is everyone thinks that the United States is going to see really high rates of inflation. But in a global economy where supply chains and production is all around the world, if there is a price hike in the United States for goods and services, then lower cost producers elsewhere in the world are going to import and meet that demand at a lower price point and bring that down. So we're in a globally synchronized economy that, unless it all creates inflation together, is not. And so far, we're not seeing that in the Chinese manufacturing data. Let's go on into the Tuesday data. How about in Spain? We see now from 57.7 to 59.4. So what does that tell us? It tells us the Spanish manufacturing sector expanded at a slightly faster rate. So potentially the rate of growth now is starting to slow down. It's faster, but it's not as fast as it's been. If we look at Italy, same story, a less than 2-point increase. So, the Italian manufacturing sector increasing, but at a slower, the pace is starting to slow down. So that is not perhaps a sign that we're seeing a boom coming out of Europe. And looking at the French manufacturing sector, expanded at the same rate. So, that isn't showing that a big boom is continuing there. Perhaps this is the beginning of a slowdown coming from Spain, Italy, and even France. How about Germany now expanding at a slightly slower rate from 66 to 64? So perhaps the German manufacturing juggernaut is giving us a little early lead, because remember, it led some of the other countries there in Europe up. Maybe now it's going to lead some of the other countries back down. And how about the broad Eurozone expanding at pretty much the same rate, 62.8 versus 63.1 in May. So telling you perhaps we're seeing a peak in the expansion in the Eurozone, which would then indicate that perhaps there is a peak in equity prices building not only in Europe but around the world, because we know that your equity prices tend to peak within a few months or less of a peak in the manufacturing PMIs. How about Great Britain expanding at just a slightly slower rate than the month before, 66.1 to 65.6. So again, suggesting potential peaks in play. Of course, obviously, you would not know this until there's a couple more months of data, but at the moment, we're starting to see some signs that Europe potentially is seeing their manufacturing sector reaching a peak. Let's take a look at the Eurozone CPI, because this is interesting. Preliminary CPI for the broad Eurozone has dropped month over month from 0.6 to 0.3. So that is disinflationary and not a suggestion that these high rates of inflation are going to continue. Looking at the core, which excludes food and energy, it's disinflationary on a preliminary basis from 0.5 to 0.2. So here you have, kind of punching a hole in this broad, there's going to be massive inflation view on these month over month data, saying, no, we're kind of falling back into what is considered, normal numbers, maybe just a touch the slight, just maybe high average number, but otherwise these are not showing a continued pressure of inflation in those numbers at all. Let's move on into the U.S. We have two manufacturing PMIs. In the U.S., we have market, M-A-R-K-I-T, and then we have what is considered the official. It's not government produced, but it is considered the official, the ISM. Let's take a look at market. Market expanded virtually just slightly above the prior month of 61.5 to 62.1. So again, we're looking at the rate of growth slowing down here, suggesting that perhaps a near-term peak in the manufacturing PMI from market. And let's look at the ISM. What do we see here? Manufacturing PMI 60.7 to 61.2. Again, this thing, it expanded at a faster rate, but that faster rate is not as fast as what we're hearing about this booming or soon to be booming U.S. economy. Looking deeper into the ISM, we'll go directly to their webpage here. And what do we see? New orders. So what do we want to see? I think that's really one of the keys is what do you want to see in an inflationary demand-led economy? Because right now we have a supply chain issue, not caused by demand, but caused by the pandemic. So what would we want to see? Well, if you really want to see inflation, you want to see new orders rising, and they did. In May, went from 64 to 67. You want to see production expanding at a faster rate, and it didn't. It went from 62.5 to 58.5. You would want to see employment, even though manufacturers always complain month after month that they can't find the right people. If they have enough demand to produce, they will hire people that aren't properly trained and get them trained. And look at this. It was almost unchanged at 50.9. That does not bode well for Friday's unemployment data. Supplier deliveries, now under normal conditions, if you were in an inflationary environment, this would be because you can't get all these goods you're producing out the supply chain. In this case, we have an issue of we don't have enough workers in the supply chain moving goods and services around. So this is this went up to 78.8, one of the highest it's ever been. But this trend is for 63 months. So we know we've not been on a 65-year inflation boom. Looking at inventories, these are almost flat. The month before they contracted very slightly. In May they expanded at a super slight rate over the month before. So no real change in inventories. Customers have been complaining for almost 5 years that they don't have enough inventory, and that doesn't bode exactly with what we're seeing in the retail and wholesale inventory data we've looked at recently. Prices paid backed off slightly, but you've seen a lot of firms driving their prices up. This is what you would normally see in an inflationary environment, but this, because of the pandemic, is not going to hold, because you want to come back to new orders, production, employment, and say, wait a minute, there's a problem here. Is new orders up because there's a lot of demand, or are people just getting their spot in the supply chain so they don't run out? I think it's the latter. I mean, if we look at prices paid, let's look at the manufacturing PMI here. You can see it peaked back in March, suggesting that the U.S. equity market is within 3 months of March from peaking. So it's usually somewhere between 0 and 3 months, suggesting that we're in the process of seeing a peak in the equity market. Now, does that make any sense? Let's look at the charts here, and we'll pull up the S&P 500. And we'll zoom out and say, hey, is it possible we're seeing a peak here? And the answer is, yeah, it's possible. I mean, it's probably a little early to call for sure, but there's an indication that, hey, stock prices just aren't going any higher. Now let's go and look at the prices paid subcomponent, which is an indicator of inflation. And this, usually you see inflation or interest rates peak within 0 to 3 months of this peaking. Now, the last major peak was in February, and then we got a push here in April and then May. So now April is the peak, but this is interesting because if we look at yields, we'll look at the long bond, the 30-year yields. Well, it peaked back in March. So the long bond saying, look, we already know this inflation story is kind of behind us. We're not buying into this soft survey data at all. And remember, the hard data tends to put the survey data in check, indicating that the ISM is telling us, yeah, there is absolutely a peak going on here in yields and equity prices. Let's go back to the data here and see what else we've got. South Korea CPI month over month for May, 0.1. Disinflationary because it's down from 0.2. Again, not a big inflationary numbers that we're hearing we're supposed to see, because South Korea, big exporter, where are you going to see inflation first? From the exporters. Not seeing it there at all. How about into today's data? Eurozone producer prices up 1% in April. So there's definitely inflation going on in the factory sector, but it's not being passed on to the consumer space. That's what's interesting. If a lot of people still talking about how interest rates can only go up. And remember, there's a supply and demand component here. Mortgage applications down 4% last week. Let's look at the purchase index. And what this is telling us is the demand for new loans. Well, it's below where it was in the pandemic recently. And that, oh, no, I'm sorry, pandemic is over here. I was looking at this little drop here, is heading lower and is now tied for the lowest point this year. So if you're looking for demand in the housing space, you're not seeing it in purchase applications. How about the total mortgage market? Well, that is telling you that there is no demand for higher rates either. As you can see, this thing is heading lower. In fact, you have to go back to early 2020 to find out when demand for mortgages was this low. There's your pandemic low. That was one number I was looking. Well, that's not the pandemic low either. Pandemic low is somewhere. Oh, actually, that would be over here, 2020. So, anyways, you're seeing a lack of demand for mortgages, which means a lack of demand for higher rates. It's telling you that higher rates are not going to be substantiated because there isn't a demand for them. And let's talk about where hedge fund managers are positioned. And this is pretty interesting because now hedge funds are going long the 10-year all of a sudden, but they're still short the 30-year. So they increased their shorts on the 30-year. So they're still betting that the long bond is going down. And we've looked recently how this is in a major bottoming pattern. We'll probably come back maybe tomorrow with a show on this and update on Momentum Timer Pro and see what it sees about this. And let's take a look at crude. Demand for crude in terms of speculative positioning is unchanged as crude prices head higher. Again, the market is looking at crude saying there's going to be this massive amount of demand. And yet people are about to lose their, 20-some states are going to lose their extended unemployment benefits. I mean, that's a problem. So looking at how hedge funds are positioned, S&P slightly short, going longer in Euro futures, so that should put upward pressure on gold, downward pressure on the dollar, and sure enough, they've expanded their long positions on gold. That makes sense. I imagine when we get to their dollar positions, we'll see that they may perhaps have gone down. Slightly more net short than NASDAQ, but no significant positions there. None changed on their major short positions on the Russell. And looking at the dollar, virtually unchanged there. So dollar potentially in a large double bottoming pattern. We'll see how that plays out, and unchanged in the volatility space. Looking at the details though, we see that in the ultra bond, these are 25 plus year maturity long bonds. You can see the short interest here is at 345,000 contracts from speculators versus 60,000 long. You see, look at asset managers. They're long the long bond, long the ultra bond at 658,000 contracts, but nervous because they're short 304,000, but they overall are net long. And as some of these shorts from asset managers get pulled off, we can easily see this take off, and you can see dealers are super short too, 23,000 long versus 100,000 short, as dealers having to hedge against downside moves in the bond market. So what we could say is that in 2 weeks, it'd be interesting to hear what the Fed says, see if they come in and bail out the banking system. Because can this lead to a crisis? It's possible. It'll be something, if it does, we have not seen before, and something not only regulators aren't expecting, but no one else is. Because how can you have a crisis when there's too much money in the system? Well, think about this. Here's what I'll leave you with this parting thought. If two banks are the recipients of most of the cash, and those two banks' balance sheets are expanding and are going to get further penalized for having big balance sheets due to the Basel III regulations. And when the Fed does QE and does its reserve swap, well, who is it going to swap most of those reserves with? Those two banks, B of A and JP Morgan, which means money is going to get tied up between two banks. And in a dollar shortage, money doesn't move very fast between two banks. So if we do have this thing blow up, it'll be shocking for most people, because how can you have a financial system blow up when there's all this money in the banking system? Well, you can if it's trapped between two banks. I'm your host, Steven Van Metre. Thanks for joining me today. We'll see you maybe tomorrow. If not, we'll be back on Friday for our macro show. Thanks for watching. Thanks for being fans. And of course, thanks for liking the stick figures. We'll see you. Bye now. The content of this video is provided as educational information, is not intended to provide investment advice. Shows not to be construed as a recognition or solicitation by selling security, financial instrument, or participate in particular trading strategies. This video was prepared by Steven Van Metre, personal capacity. Opinions expressed in this video that do not reflect the view of Alice Financial Advice Inc. or Steven Van Metre Financial.